Financial markets are dynamic environments that constantly shift between different phases. At times, the market trends smoothly in one direction, allowing traders to follow momentum. At other times, it moves sideways in a ranging pattern where prices fluctuate within a limited area, creating confusion about the next major move. There are also periods of intense volatility when prices rise and fall rapidly in short bursts. These constant changes mean that traders are always operating in an environment filled with uncertainty. Unlike many other professions where outcomes can be predicted with a reasonable level of stability, trading exposes individuals to continuous fluctuations and sudden price reactions. Every moment, the market produces new information in the form of price movements, news releases, and economic data. This nonstop stream of information forces traders to interpret signals quickly while their capital remains exposed to risk. Because prices can move within seconds, traders often feel pressure to respond immediately. This environment naturally stimulates emotional reactions, especially for individuals who have not yet developed strong psychological discipline. One of the most common emotional responses in trading is fear. Fear usually appears when a trader experiences a sudden loss or when the market begins to move aggressively against an open position. Even a small loss can trigger anxiety because money is directly connected to personal security and self-confidence. When fear takes control, the mind shifts from rational analysis to protective behavior. Instead of evaluating the market objectively, the trader becomes focused on avoiding further pain. This often results in closing positions prematurely, hesitating to take valid opportunities, or abandoning a well-planned strategy. On the opposite side of fear is greed. Greed tends to appear during strong price movements when the market moves rapidly in the trader's favor. Instead of calmly following the trading plan, the trader begins imagining larger profits and extended trends. This emotional excitement encourages riskier decisions, such as increasing position size without proper analysis or holding trades far longer than originally planned. Greed can also push traders to chase price movements after a large move has already occurred, entering the market at the worst possible moment. Rapid market changes intensify these emotional reactions. When prices move quickly, traders often feel they must act immediately or risk missing an opportunity. This sense of urgency triggers impulsive behavior. Rather than calmly analyzing the market structure, many traders begin reacting to each candle or small price fluctuation. They may jump into trades based on incomplete signals, or they may close positions simply because the market pauses for a moment. These impulsive reactions are rarely part of a structured trading plan. Instead, they are short-term emotional responses created by the pressure of the moment. Over time, this behavior leads to inconsistent decision-making, where each trade is influenced more by emotion than by a repeatable process. The financial cost of emotional trading can be significant. One common consequence is entering trades too late. When traders watch a strong move develop, fear of missing out can push them to enter after the majority of the movement has already occurred. By this stage, the market may be approaching exhaustion, which increases the probability of a reversal or pullback. Late entries often result in immediate drawdowns that reinforce frustration and emotional stress. Another frequent problem is exiting trades too early. A trader who is afraid of losing profits may close a position the moment the market shows a small retracement, even though the original trade setup remains valid. As a result, profitable opportunities are cut short while losses are sometimes allowed to grow. This imbalance between small profits and larger losses gradually erodes trading performance. Emotional trading also leads many individuals to ignore their own risk management rules. A trader might originally plan to risk only a small percentage of capital per trade, but after experiencing several losses, frustration may push them to increase position size in an attempt to recover quickly. This behavior transforms trading from a strategic activity into a form of emotional gambling. When risk management rules are abandoned, a single impulsive decision can damage months of disciplined work. Consistency disappears because decisions are no longer guided by a structured framework. Volatility further amplifies these psychological pressures. Fast markets create an atmosphere of urgency where every second appears critical. The faster the market moves, the more traders feel compelled to act immediately. Unfortunately, urgency has a direct effect on cognitive performance. When the brain perceives time pressure and financial risk simultaneously, analytical thinking becomes weaker. Instead of calmly evaluating probabilities, the mind switches into a reactive state designed for immediate survival rather than long-term strategy. In this reactive state, traders rely on instinct and emotion instead of logic and planning. Decisions become faster but less accurate, and the quality of execution deteriorates. This shift from analysis to reaction is one of the most destructive forces in trading. A trader may possess a well-researched strategy, clear entry conditions, and carefully defined risk management rules. However, if emotional pressure overrides these rules in real time, the strategy itself becomes irrelevant. The trader begins acting outside the boundaries of their system, turning structured trading into unpredictable behavior. Over time, this inconsistency makes it impossible to measure performance accurately because each trade is executed differently. The deeper insight behind these patterns is that emotional instability naturally produces inconsistent execution. Even the most sophisticated trading strategy cannot perform well if it is applied differently on every trade. Consistency in trading does not come from predicting every market movement correctly. Instead, it comes from executing the same process repeatedly with discipline and clarity. When emotional reactions dominate decision-making, that consistency disappears. Trades are entered for different reasons, exits become random, and risk levels fluctuate unpredictably. For this reason, psychological stability becomes one of the most valuable advantages a trader can develop. Markets will always remain uncertain and volatile, but the trader's internal response to that uncertainty can be controlled. By learning to recognize emotional triggers and maintaining a structured decision-making process, traders can protect themselves from the destructive cycle of fear, greed, and impulsive action. Over the long term, the traders who succeed are rarely those who predict the market perfectly. They are the ones who maintain emotional control, execute their strategy consistently, and remain disciplined even during the most challenging market conditions. Calm decision-making is one of the most important psychological abilities a trader can develop. Financial markets constantly present situations that can trigger strong emotional reactions, especially when real money is involved. Prices move rapidly, profits can appear and disappear within seconds, and losses can feel personally threatening. In this environment, the difference between successful and struggling traders often lies not in technical knowledge, but in the ability to remain emotionally balanced. When a trader learns to stay calm and neutral regardless of market conditions, decision-making becomes clearer, more structured, and more consistent over time. Emotional regulation plays a central role in this process. In trading, emotional regulation means maintaining a neutral mindset toward both wins and losses. Many traders believe that success in trading should feel exciting, but extreme excitement can be just as harmful as fear. When traders become overly excited after a profitable trade, they may begin to believe they have special insight into the market. This confidence can quickly turn into overconfidence, leading to larger position sizes or careless entries. On the other hand, frustration after a loss can create a desire to immediately recover the money, which often results in revenge trading. Emotional regulation prevents these extremes by encouraging a balanced response to every outcome. Profits are treated as normal results of a disciplined process, and losses are accepted as natural components of probabilistic trading. By remaining emotionally neutral, traders protect their ability to think clearly regardless of what the last trade produced. Maintaining balanced reactions becomes especially important during volatile market conditions. Volatility often creates dramatic price movements that attract attention and stimulate emotional responses. Sudden spikes or drops can create the impression that urgent action is required. However, calm traders understand that volatility is simply a characteristic of the market rather than a personal threat or opportunity. Instead of reacting emotionally to rapid price changes, they observe how the market structure is developing. This calm observation allows them to interpret information objectively rather than being driven by momentary excitement or panic. Patience is another essential psychological component of calm decision-making. Financial markets operate continuously, producing endless movements throughout the day. This constant activity can create the illusion that opportunities are always available. Many traders feel pressure to participate in every noticeable move, fearing that staying inactive means missing potential profits. In reality, disciplined trading often involves long periods of waiting. High-quality trade setups usually appear only under specific conditions, and forcing trades outside those conditions often leads to poor outcomes. Patience allows traders to wait for confirmation before entering the market. Instead of reacting to the first sign of movement, they observe whether the market structure aligns with their predefined criteria. This waiting process filters out many low-probability trades that impulsive traders might take. Patience also reduces the psychological pressure associated with constant decision-making. When traders believe they must always be active, every small market movement becomes a potential trigger for action. This creates mental overload and increases the likelihood of mistakes. By accepting that not every moment in the market offers opportunity, traders free themselves from the need to react continuously. They become selective rather than reactive, focusing their attention only on situations that meet their strategic requirements. Calm thinking also improves clarity under pressure. When emotions intensify, the brain tends to narrow its focus and prioritize immediate reactions. This biological response is useful in physical danger, but problematic in complex analytical environments like trading. Emotional stress introduces mental noise that interferes with objective interpretation of market data. Traders under stress may misread price structure, exaggerate the significance of minor movements, or ignore important contextual signals. By maintaining calmness, traders reduce this internal noise. Clear thinking allows them to evaluate patterns, trends, and risk levels with greater accuracy. As emotional distractions fade, analytical reasoning becomes more effective. Decision quality naturally improves when stress levels are controlled. Calm traders can process information more systematically and compare current market conditions with their trading plan. Instead of reacting to temporary fluctuations, they focus on the broader context of price behavior. This perspective helps them distinguish between meaningful signals and random noise, which is essential for consistent performance. Mental discipline reinforces this process by ensuring that decisions remain aligned with predefined rules. A well-designed trading plan outlines specific conditions for entering and exiting trades, as well as risk management guidelines. However, the presence of rules alone is not enough. Traders must have the discipline to follow those rules consistently, even when emotions attempt to interfere. Mental discipline allows traders to execute their strategy without hesitation once the conditions are met. It also prevents them from making impulsive adjustments during active trades simply because the market temporarily moves against them. Accepting uncertainty is another critical part of mental discipline. No trading strategy can guarantee a winning outcome on every trade. Even the best strategies produce losses as part of their normal statistical distribution. Traders who accept this uncertainty are less likely to panic when a trade does not immediately move in their favor. Instead of interpreting losses as personal failure, they view them as normal variations within a larger probability framework. Over time, consistent emotional control leads to psychological stability. When traders repeatedly practice calm decision-making, their confidence gradually strengthens. This confidence does not come from individual wins but from trust in their own disciplined process. As stability develops, traders experience less emotional turbulence after each trade, which significantly reduces long-term mental fatigue. Trading becomes less exhausting because decisions are guided by structured thinking rather than emotional reactions. This psychological stability makes clear thinking sustainable over long periods. Instead of constantly battling emotional highs and lows, traders maintain a steady mental state that supports consistent performance. In the long run, this stability becomes one of the most powerful advantages in trading, allowing individuals to navigate uncertain markets with patience, clarity, and disciplined control. Calm behavior has a direct and measurable influence on trading performance. While many traders focus primarily on strategies, indicators, or technical patterns, the way a trader behaves during real market conditions often determines the actual outcome. Emotional stability allows traders to apply their strategies with consistency and discipline, while emotional reactions frequently lead to poor execution. When a trader remains calm, every stage of the trading process improves, from selecting entries to managing risk and exiting positions. Over time, these improvements create more stable and sustainable trading results. One of the first areas where calm behavior creates an advantage is entry selection. Markets frequently produce rapid price movements that can tempt traders to react immediately. When prices begin moving quickly in one direction, many traders feel pressure to participate before the move appears to disappear. This reaction often leads to chasing the market, which means entering trades after a large portion of the move has already occurred. Chasing price movements increases risk because markets commonly retrace after strong impulses. Calm traders behave differently. Instead of reacting to the speed of the movement, they focus on the quality of the setup. They wait for conditions that align with their predefined trading criteria, such as clear structure, confirmation signals, or favorable risk to reward conditions. This patience reduces the likelihood of entering trades based on emotional urgency. As a result, calm traders typically participate in higher quality opportunities rather than random price fluctuations. Improved entry selection naturally leads to better overall trade positioning. When trades are entered at logical points within the market structure, the distance between entry and stop loss becomes more manageable. This creates better risk control and increases the probability that the trade can develop according to the original plan. By avoiding impulsive entries, calm traders place themselves in situations where the market has a higher chance of moving in their favor. Another critical area influenced by calm behavior is risk management. Risk management is the foundation of long-term trading survival, yet it is one of the most commonly violated principles during emotional trading. When traders become anxious about losses or overly excited about potential profits, they may ignore the risk limits they originally established. For example, a trader might widen a stop loss to avoid accepting a loss or increase position size after several losing trades in an attempt to recover quickly. These emotionally driven decisions can dramatically increase exposure to risk and lead to large account drawdowns. Calm traders approach risk management with discipline and consistency. They respect their stop-loss levels because those levels were determined through analysis rather than emotion. They also maintain consistent position sizing so that no single trade has the power to significantly damage their trading capital. By avoiding emotional risk escalation, calm traders protect their accounts from extreme volatility caused by impulsive decisions. Calmness also plays a significant role in exit decisions. Exiting trades is often more psychologically challenging than entering them. Once a position is open, every price movement can trigger emotional reactions. A small pullback during a profitable trade may create fear of losing profits, while a temporary move against the position can create panic about further losses. These emotional responses often lead to premature exits. Traders close positions too quickly because they want to remove the discomfort created by uncertainty. Calm traders manage exits differently. Instead of reacting to every small fluctuation, they focus on the structure and logic behind their trading plan. If the trade setup remains valid, they allow the position to develop naturally. This disciplined approach helps them capture the full potential of strong market movements rather than cutting profits short due to temporary volatility. Another important benefit of calm behavior is the reduction of overtrading. Overtrading occurs when traders open too many positions simply because they feel the need to be active in the market. Financial markets operate continuously, producing endless price movements that can easily create the illusion that opportunities are always available. Traders who lack emotional control often feel uncomfortable staying inactive, so they begin taking trades that do not fully meet their criteria. This constant activity increases transaction costs, reduces focus, and leads to a higher probability of mistakes. Calm traders recognize that inactivity is often a strategic decision rather than a missed opportunity. They understand that waiting for the right conditions is part of the trading process. By trading less frequently, but with greater selectivity, they shift their focus from quantity to quality. This approach reduces unnecessary exposure to risk and helps preserve mental clarity throughout the trading session. Reduced overtrading also improves concentration. When traders take fewer, but more carefully selected trades, they can dedicate more attention to analyzing those opportunities properly. This deeper focus allows them to observe market structure, risk levels, and potential exit points more clearly. Instead of constantly switching between multiple impulsive decisions, they maintain a structured and deliberate approach to trading. Over time, these behavioral advantages combine to create more stable trading performance. One of the most visible signs of disciplined trading is a smoother equity curve. Rather than experiencing dramatic gains followed by equally dramatic losses, calm traders often produce gradual and consistent growth. This stability occurs because their decisions are based on a repeatable process rather than emotional impulses. Losses still occur, but they remain controlled within predefined risk limits. Stable performance also reduces psychological stress. Trading can be mentally exhausting when every decision is influenced by fear, excitement, or frustration. Emotional swings create constant tension that drains mental energy and reduces focus. Calm traders experience less of this internal conflict because their actions follow a structured plan. As a result, trading becomes more sustainable over long periods. Ultimately, calm behavior strengthens long-term consistency. Financial markets will always remain uncertain and unpredictable, but a trader's internal response to that uncertainty can remain stable. By maintaining patience, discipline, and emotional balance, traders create conditions where their strategy can operate effectively. Over time, this consistent execution becomes one of the strongest drivers of reliable trading results. Calm trading creates advantages that extend far beyond individual trades. While many traders focus on short-term profits, the real value of emotional stability becomes visible over long periods of market participation. Financial markets constantly evolve, shifting between trending phases, ranging environments, and periods of extreme volatility. Traders who rely heavily on emotional reactions often struggle to adapt to these changes because their decisions are influenced by fear, frustration, or excitement. Calm traders, however, approach market conditions with a more flexible and analytical mindset. Because their decisions are not driven by emotional pressure, they can evaluate new conditions objectively and adjust their strategies accordingly. When the market becomes slow and ranging, they are able to reduce activity and wait for clearer opportunities. When strong trends develop, they can participate with patience rather than chasing price movements impulsively. This adaptability allows calm traders to operate effectively across a wide range of market environments instead of relying on a single rigid approach. Emotional stability also reduces resistance to change. Traders who become emotionally attached to a specific bias or prediction often struggle to accept when the market moves in a different direction. They may hold losing positions too long or continue applying strategies that no longer fit the current environment. Calm traders maintain greater flexibility in their decision-making because they are less attached to being right. Their primary focus is not proving their analysis correct, but responding intelligently to the information the market provides. This openness allows them to adapt faster and maintain consistency even when conditions shift unexpectedly. Another powerful advantage of calm trading is longevity in the market. Many traders enter financial markets with enthusiasm, but leave after experiencing severe losses or emotional burnout. Catastrophic losses often occur when emotional decisions override risk management principles. A trader who becomes frustrated after several losses may suddenly increase position size in an attempt to recover quickly. Similarly, excessive confidence after a series of profitable trades can lead to overexposure and careless risk-taking. These emotionally driven behaviors significantly increase the probability of large drawdowns that can destroy trading capital. Calm traders are less vulnerable to these extremes because they maintain discipline even during stressful situations. They respect risk limits, maintain consistent position sizes, and avoid impulsive decisions that could threaten their account. Capital preservation plays a central role in sustaining a long trading career. The ability to remain active in the market for many years depends largely on protecting capital during difficult periods. Losses are inevitable in trading, but disciplined traders ensure that those losses remain manageable. By controlling risk and avoiding emotional escalation, calm traders create conditions where recovery remains possible. This steady approach allows them to survive periods of unfavorable market conditions and continue participating when opportunities improve. Over time, disciplined behavior also produces a compounding effect. Many traders focus on large individual profits, believing that success requires dramatic winning trades. In reality, long-term growth in trading often comes from smaller, consistent gains accumulated over many transactions. When traders apply disciplined risk management and follow their strategies consistently, these modest gains gradually build upon each other. Compounding allows even small improvements in performance to produce meaningful growth over extended periods. Another benefit of disciplined trading is the reduction of large drawdowns. Severe losses not only damage trading capital, but also create psychological pressure that can lead to further mistakes. Recovering from a deep drawdown requires significantly larger gains than maintaining steady growth. For example, a trader who loses half of their capital must double their remaining account simply to return to the starting point. Calm traders reduce the likelihood of these extreme setbacks by maintaining consistent risk exposure and avoiding emotionally driven decisions. With smaller drawdowns, recovery becomes faster and less stressful, allowing the trading process to remain stable. Emotional independence from market noise is another key advantage developed through calm trading. Financial markets are surrounded by constant streams of information. News headlines, economic announcements, social media commentary, and sudden price movements all compete for the trader's attention. For many traders, this flood of information creates confusion and emotional pressure. They may change their trading decisions based on rumors, short-term reactions, or dramatic news events. Calm traders develop the ability to filter out much of this noise. Instead of reacting to every headline or market rumor, they maintain focus on the structure and logic of their strategy. This independence from external influence strengthens decision-making confidence. When traders rely heavily on outside opinions or emotional reactions to news events, their decisions become inconsistent. Calm traders build confidence gradually through experience and disciplined execution. They trust the process they have developed and rely on their analysis rather than constantly seeking validation from external sources. Over time, this confidence allows them to remain steady even when markets become chaotic or unpredictable. Ultimately, calm trading provides a broader perspective on risk and uncertainty. Calmness does not eliminate the inherent risks of financial markets, nor does it guarantee profitable outcomes on every trade. Losses will always remain part of the trading process. However, emotional stability significantly improves the quality of decision-making under uncertainty. By remaining composed during both profitable and difficult periods, traders can apply their strategies with greater consistency and discipline. Consistency is one of the most valuable qualities a trader can possess. Markets constantly change, and no single prediction will always be correct. Traders who succeed over the long term are not necessarily those who react faster than others or predict every movement accurately. Instead, they are individuals who maintain clear thinking even when the market becomes unpredictable. Emotional control allows them to navigate uncertainty without abandoning their structured approach. In the end, the greatest advantage in trading is not speed but clarity. Financial markets will always remain uncertain and unpredictable, producing sudden movements and unexpected outcomes. Emotional reactions often lead traders to create unnecessary mistakes during these moments of volatility. Calm decision-making, on the other hand, strengthens discipline, improves analytical thinking, and supports consistent execution. When traders maintain emotional stability, they create a foundation for sustainable performance. In trading, success is rarely determined by reacting faster than the market. It is determined by thinking more clearly when the market becomes chaotic.